Good afternoon and welcome. Zach Strickland and Brad Ganane here, going to kick off our weekly Sonar Market Insights webinar. We're going to stick to our 30-minute-ish schedule and allow some time for Q&A after. Before we get started with the script, I would like to give a quick announcement regarding our FreightWaves 18 event in Grapevine, Texas, November 12th and 13th. We're going to be holding some sonar education courses / classes during that two-day event, November 12th and 13th. We have a ton of people, sonar users, and that are going to be there. We're very excited to see, and I don't think you even quite knew that we were going to do these, so we're pretty excited to interact and continue the education process with Sonar. So those that are interested that don't know much about FreightWaves, please get in contact with us via sales@freightwaves.com or on the website, freightwaves.com. And with that, we're going to go ahead and jump into some of the content that we have for this week. Most notably, would like to bring up that we're going to be adding, I believe it's on Monday, about 3,000.
No, those have already been added.
They're already added. They're already in about 3,000 additional origin destination points, or 3,000 lanes that have been input to Sonar via tender rejections. So if you haven't had a chance to check those out, there is a lot more granular data from a lane standpoint. So that's pretty exciting stuff. And then we're going to talk a little bit more about diesel consumption. I think we may have mentioned it last week. ULSD is the ticker for that one, which Zach's going to go into a little more detail. And then we're also going to discuss the Institute of Supply Chain Management Metrics, which is currently pulled up on the screen, and what that's telling you, how it is created. And we're going to discuss the month of October as well, a very exciting month. Not so exciting so far, actually, I should say. And then we're going to discuss Hurricane Michael a little bit, and then a few things on the horizon that are going to be going into Sonar and some changes. So with all of that, I will hand it over to Mr. Strickland to talk initially about the Institute of Supply Chain Management Metrics.
Hello. Yes, we added the ISM tickers into Sonar this week. This one it's pretty intriguing to me. I didn't know a lot about these guys until we started trying to implement this into Sonar, and I learned a ton about it. And in the process, I learned a ton about kind of what goes into certain aspects of how we measure the economy and economic growth. This is somewhat similar to our other macroeconomic data that is based on like the government, Census Bureau and BLS, all that kind of data and employment levels and whatnot. But what they've done, since the ISM is private, they're not kind of bound by the same standards and bureaucracy as government entities are. They can kind of be a little bit more flexible with their methodology, although they do keep it consistent. One of the most highly regarded indexes in terms of measuring the economy are produced by the Institute of Supply Management. And what they do is they basically aggregate a bunch of data on employment, production, anything in the process of supply chain, the prices, all this stuff goes into a big mixing bowl, and they kind of divide it up into several indices. We have 22 indices, and the one that I have pulled up right now is the Purchasing Managers Index. And essentially, this is kind of their version of the GDP. And what it does is it basically measures the health of the overall economy, the broader economy, if you will. And it's not necessarily, GDP, if you just looked at the number itself, it would just go up and to the right, with a few times where it would kind of flatten out a little bit and then go up again. Well, this is kind of measuring that GDP growth rate, if you will. And a good point of reference for any of these indices is to just note anything above a 50 is generally positive. Anything below 50 is not so great. So if you can see right here, I just baseline this to a 50 value. We've been going pretty hot and heavy since last year. It's been quite positive throughout 2017 and into 2018. We are now sitting at a value of a 59.8. August's value was relatively high. And now at the end of September, things are still going well, but they're not going as well as they have been, which again, you're talking about relative wellness here. And so what we're saying is the economy is still looking pretty strong. Although, everybody kind of thinks just because things weren't as good as they were yesterday,
Right.
they take it as a negative or the sign that the sky is falling, that type of thing. But still, go ahead, Brad.
Sorry, I was going to say, and as our users start to operate outside of kind of the day-to-day, week-to-week type of data sets centered around tender-related indices like rejection, volume, and such, there are some different methodologies and different values in which these are displayed. For example, especially when there's third-party data. So a quick reminder, view symbol information on the bottom left of your screen gives you a quick jump into explain what you're looking at. So
there you go.
Just don't forget that that's down there as you're
if you need a quick explanation of what it is, etc. And we still have, of course, all of our material on the website and the Knowledge Center, which we are in the process of updating, by the way. So really excited about some of the changes we've got going on there coming up. ISM, let's see, I'll type in ISM. So you can see here all of these new indices are listed out. If you just type in ISM and you can go through various, these are basically divided up into two categories of manufacturing and non-manufacturing. Each of them have their own exposures to, kind of the service industry versus the non-service industry is essentially what this is saying. So you can divide this up into, various parts of the supply chain in general. There's all sorts of explanations on what this stuff actually means and what you can gather from it. But essentially what you want to do is see anything that looks above the value of 50, things are going well in that particular segment. So in addition to the Institute of Supply Management, we have added ultra-low sulfur diesel, rack rate and volume to, it's available at a market level on a daily basis. So again, why would we add ultra-low sulfur diesel to this? Well, trucks, we are a trucking centered organization, mainly surface transportation, freight, and trucks are a huge part of that and what we do. Ultra low sulfur diesel fuels the majority of those trucks as it stands today. So anytime that you see an increase in rate or volume, that has a dramatic impact on trucking in the United States and in Canada and Mexico. So monitoring these rates where they are in specific markets can give you some insight into how that particular, what fuel levels are like in that area. So as people purchase more gas at the rack, which you can, for those of you that don't know, I should back up a little bit. The rack rate is essentially a wholesale price. So it's the rate at which the retailer pays for the gas or the fuel. So, there's no markup in here from the retailer. There's no taxes from the government. It's basically the refineries markup and their internal costs and overhead to produce this ultra low sulfur diesel. So what's interesting to me is you can go in here now and I have the rack price pulled up, but we also have the retail price available. And I'm going to actually compare those two. So if I put the DTS, some of you may use this, some of you may not, but I'm going to go ahead and pull it up to kind of show people. And I've got this on the relative. I need to put it on absolute. So it's expressed in a rate per gallon. So as I pull up the rack price, I can pull up the retail price, and you can see there's your markup. So this range right here, essentially, you're seeing there's a big amount of, it's not just necessarily markup, but it's also taxes. So there's a big discrepancy in what people are paying wholesale versus what people are paying on the retail end. It's quite important. You can kind of see what happens on the wholesale level doesn't always correlate exactly with the retail level. So you're seeing that some of these, at times, the wholesale level goes up and the retail level does not increase in the same rate. Again, quite interesting for me to kind of look at this from a pricing perspective and anticipating fuel changes and increases and how the market's moving. ULSD volume, however, is a totally different value, I think. So I'm going to pull up rack volume for the Houston market. And this essentially, again, this is a daily value. So what you're seeing is this kind of weekly rhythm of diesel purchase. And I'm going to make this a little bit easier to kind of follow. I throw in a mountain on here, and something that I like to do with these weekly rhythm metrics is throw a moving average on top of it. Like a 7-day moving average basically smooths it out and gives you a lot easier way to kind of look and see what, these overlying trends. So right here, you see that diesel volume purchases went down during Labor Day, and then they come back up.
So what can our users do with, whether it be fuel price at the rack or volume? What can they do with that information and, applying it to maybe some of the data, some of our proprietary data sets? What are some things or some conclusions that they may be able to come to, or, what areas they may be able to recognize something that the rest of the market may not be able to if they don't have the ability to look at these data sets side by side.
Sure. So essentially what rack volume is kind of a measure of, one, what do the purchasers think that fuel price is going to do? If they think that it's going to go up, then you're potentially going to see a surge of purchase in the rack volume itself. But also, if they think that they're going to use more fuel, the volume will go up as well. So there's two things. And because we've divided it out into regions and markets, you can actually kind of infer what people are basically expecting the market to do. Or, you're getting a little bit of a leading indicator on how things are about to happen, or potentially even if you have a surge of volume in a specific market, that should show up here as well. And the rack price will also kind of reflect that on a different level. Again, it's good to know in certain markets, because gas prices move different ways in different areas of the country, which is why rack price is so important. If you go out to California, you know that your fuel price, your retail price for sure is heavy, because the government has a lot of taxes out there. But if you see kind of a constriction of the markup in there, you can expect that the rate is going to increase in that particular market eventually. Certainly as things get elevated. So diesel basically moves the trucks, so that it's a derivative, and it's something good to use to kind of see what the general freight market is doing. And right here, you can see that volume has kind of fallen off in the Houston market. You see as trucking activity falls off, so does the diesel volume. Something important to look at. I think everybody's kind of looking at that. All of our indices and data are kind of trying to answer similar questions, like what the general economy is doing. Now, how does that relate to our daily kind of operation and the best decisions? Because what we're essentially trying to do is figure out, what do we need to do to get ready for what's happening tomorrow, what's happening right now, how can I better manage my fleet, my practices and whatnot. And diesel volume is just one more value that kind of adds on to the growing number of values we're using to kind of get all that insight, because you really don't want to make decisions off of any one source. As good as that PMI is for the Institute of Supply Management, in aggregating all their numbers together, it's still kind of one source. You want to kind of weigh that with other data. You know what I'm saying? So the more different sources you get, the better your whole picture is going to be, the better predictive analytics you're going to have. And lastly, the thing that we added, which I don't really have to show you here, but our tender rejection indices, I-try and O-try, they now have a lot more lanes available. Let's see here. So some of you may have already noticed that are interested in, some of these kind of more obscure lanes or more targeted lanes. You may actually have a lane value out there now that you didn't before. As we get more data and subsequently better at kind of managing our data, we're able to kind of build on that and add more complexity to it to make it more usable, kind of expand, the options that our users have. As a former analyst myself, I like to break things down as far as I could possibly go to get as targeted as I could possibly get. There's a lot of people out there that only have an interest in certain regions of the country. The lanes will just help you, have another option in terms of getting a better feel for what's going on in the areas that you're particularly interested in. I know on here we kind of stay at a pretty high level, and that's intentionally, and that's because, we don't want to get too granular. Because, it's kind of like we want to appeal to the broader market and the broader audience, but certainly the users have the option to kind of really dig down to what's important to them. And we do have some new features coming up in the next coming weeks that'll make that easier as well, that you'll touch on.
Yes, we will.
Later, if you want.
But to go back to the low sulfur diesel and kind of declining here in October in Houston, I know you don't have to pull it up if you don't want to, but I think that's a good segue into what we wanted to discuss next, and that's the month of October, which has had a lot of discussion internally here. And we won't call them arguments, we'll say difference of opinions, and just from the amount of different backgrounds I think that we have from brokerage to asset-based carriers to carriers with assets and with a brokerage to people that have worked for shippers. There's a lot of people that have worked in different segments, and within those different segments in the industry, they've had different focuses within those segments, I should say. So there's been, I think, some very interesting discussions over the past week as to what's happening in October, why is it happening, and what can Sonar tell us? You have 30 seconds, go.
Oh, right. Yeah. The market in 30 seconds. Yeah. It's like PTI. So one of the things that for those of you that read FreightWaves, we put out a chart of the week this week that kind of drew attention to this kind of drop here. And these drops right here are holiday related drops in volume. And these right here are not. Easter did occur right here, but what's happening, and it's kind of hidden here because I have the baseline set at, kind of the March 1st value, is this drop at the end of quarters in volume. And you can see it over time throughout the month of July. But at the end of every quarter, there's this big push of freight that happens as people kind of get all the freight off the dock that they can. These shippers are actually trying to capture as much revenue as possible as they complete orders and get as much out there. So carriers kind of want to do the same thing. So they're eager to kind of get out there and grab all this freight. But this is all started by the shippers. Mm-hmm. So this right here is measuring the shippers kind of, how much freight are they trying to push into the system. So what that does, though, is it kind of leaves this, lagging hole because they've pushed all this freight that they can at the end of the month. And then they don't really have much to ship because they've kind of pushed all their production out. It takes a little time for that cycle to ramp back up and to get volume back into the system. And typically that is kind of a quarterly industrial rhythm that we've kind of grown to kind of accept, especially in today's economy. I know back in the day that I would get calls the last day of the month asking for favors to get people, to get freight moving from the shippers so they could get it off the dock, because those transportation managers are sitting there with freight piling up on the dock. The production guys have been, getting pushed to do as hard as they can do. And that guy can't leave until that freight's gone. They're not a warehouse. So it just leaves this big gap of volume falling off. Now, what that means for the month of October, a lot of people think that October may actually be a very busy month, which it actually can be an extremely busy month, especially when you're talking about the impact of hurricanes and tropical systems and Retail has a huge push at the end of the month. Depending on how people have managed their supply chains, October can be one of the most volatile months. That in early November, uh, that in the entire year. May, June are traditionally very, they get ramped up and busy. You can kind of rely on that. Uh, but October is kind of one of those months that can go either way. And for those of you that kind of are involved in the retail sector, you're going to know this every year. You get this big push of retail going out to going out to the retailers, getting ready for the holidays. People are managing their inventories. But what we have seen over the last year to 2 years is that behavior kind of changed. I know many people have heard about a little company called Amazon that is kind of pushing people to have more regionalized distribution centers. You normally, not that the distribution center is new, but now it's going to be even more regionalized than it was in the past. Whereas you could have a DC sitting in Texas, now you have a DC, servicing the entire Mid-South. Now you have a DC in Oklahoma City, Little Rock, Houston, and San Antonio or Albuquerque. So it's kind of pushing this shortening length of haul. It's enabling people to be a little bit more flexible. Now, what that means for what we're seeing in October is the fact that we think that a lot of this volume was actually pushed earlier this year due to the tariff situation as people are reevaluating. A lot of the tariff stuff, like the container volumes, came in early this year. If you look at any of the port volumes, specifically out in California, they had bigger months in May, June than they had in July, August this year, which typically over the previous 4 or 5 years, it was July and August that had the big push of containers. If many of you remember, we had a lot of kind of tariff implementation July 3rd this year that involved China. So we think that a lot of that has already happened this year, and this is going to lead to a little bit softer month of October. Now, time will tell what Hurricane Matthew, or Michael, I should say, has on the market, hitting at a time when the market's kind of going soft. But yeah, October typically is a little bit softer. You have a lot more retail activity going on, and towards the end of the month, it gets a little bit more volatile due to the fact that retail volume itself is not enough. A lot of the raw materials and supplies and production, things like the seasonal produce and everything like that has already gone through the system. So the overall volume actually tends to drop. Retail, however, creates a lot more volatility because the retail people need to get their stuff moved rapidly. They have a lot shorter cycles to manage than, say, the production cycle. The production cycle is a lot more expansive and can happen over a longer period of time because that's what they're doing. They're getting ready for this time of year. So they've already gone through their process all throughout this part of the, back into March. The factories kind of come back online in force. China is a big part of this. They turn back on going into May and June. You see a lot of this inventory. You have, your outdoor seasonal stuff, bottled waters and everything like that. Well, a lot of that stuff isn't present this time of year. It's strictly kind of retail based or disaster relief type stuff that kind of really sends the month of October into a tizzy. Right now, we're seeing a very soft October in terms of volume. And that could change, which leads us to what are we seeing with Michael?
Yes.
So far, Michael has not shown up with any real, quantitative effect in a lot of our data. And I think I know why that is. A lot of that is the fact that Michael literally sprung onto the scene 4 days ago. With Florence, and I'm going to compare a lot of this to Florence because that was the most recent event. And then with Florence, we saw it in SONAR pretty quick before the hurricane even hit. Well, if everybody remembers, Florence was actually an entity about 2 weeks before it made landfall. And about a week and a half out, everybody's kind of like, well, it's going to hit the United States more than likely. And it took its sweet time kind of meandering over here. So it gave everybody a heads up. And then as the forecast was able to get refined, it was a very slow moving storm. Michael literally was nothing, not even a depression 4 days ago. So all of a sudden the forecasters are like, oh, there's a hurricane and it's going to be a low end Cat 2, maybe a Cat 1, high end Cat 1 by the time it hits somewhere along the Florida panhandle. And then last night it's a Category 4 major hurricane. So nobody had any real time to set up for this. Also, Tallahassee, not a big market itself. If I were to pull up the outbound tender market share, which again is an index we use to kind of measure how big is this market in relation to the rest of the country. The Tallahassee market, very small.
Less than
Yeah.
0.1%, is that it?
Yeah, it's less than 0.1% of overall volume. And that's the recent value. Of course, we're seeing some down because there's not a lot of people shipping out of the Tallahassee market today. But again, it's a very small market. It's a very consumer driven market, not a heavy inbound, although that inbound is probably about to change. So my next statement is going to be not about what's happening now, but what's about to happen after Michael gets done kind of doing what it's going to do down there. And there's two separate sections to this. One is the emergency management, and then the other is the rebuilding and recovery. The emergency management tends to show up in the spot market as capacity is kind of drained out of the system down there. And one of the things I kind of want to point out is the biggest market in the area, the Atlanta market, has had a significant decline in market share volume over the last month or so, and even a more significant one over the past week. It's dropped off quite significantly, going from 4.3 to all the way down to 4. May not seem like a lot, but in this world, it's quite a bit. It had actually averaged, and I'm going to pull out here to kind of illustrate this a little more clearly. It had averaged a much higher, it's like 4.6% of the total market, outbound market, I should say, since like April. And what I'm doing is I'm kind of drawing an average line. It's kind of a tool I use to, if I want to do some sort of calculation on the chart, you can see it'll line it up and it gives you the average value for the period of time that you kind of click on and tell it to measure. So 4.63% of the total market since April 1st to the end of September, and now it's sitting down at a 4.03%. And the Atlanta market is responsible for kind of servicing that Tallahassee area. So we've got a bunch of capacity missing from the Atlanta market, and a lot of that went to the West Coast. You can see here, LA over the last, similar period of time has risen. And you see it's actually quite significant, and I'm going to do the same kind of.
When you say it's gone to the West Coast, do you mean via container, or do you mean, what are you saying it went to the West Coast?
Basically, I'm saying that a lot of the capacity has moved to out west. People are now aware that LA has freight, and they're figuring out Atlanta doesn't. So a lot of the trucks are moving out west, taking advantage of, they know this is coming up. We see it every year. The LA market kind of heats up as a bunch of stuff comes off the West Coast, filling out retail sectors. The spot market shows this. I'll go ahead and pull up the DAT. Let's see here, DATV, Los Angeles to Dallas lane. And I'm going to pull that out on a big historical measure. These are very useful in kind of measuring historical trends and averages. You can see, if I can get it to pull up, pull off this average line here. You can see that traditionally, over the past few years, this lane has had peaks at the end of the year. This is November 30th. I've got the monthly. That's why I'm not doing this right. DATVF dot lags down. There we go. So yeah, essentially we have this, come on circle. We have this monthly or this November kind of peak. So $2.38 a mile last year. Back on June, at the end of June, you have this other kind of secondary peak. You can see the June this year, we had a peak, and now you can see the rates again rising all the way back up. So people know they're about to get better the better deals going out west. Every June/November, it's a big push of freight. So when hurricanes hit and suck up capacity, FEMA, for instance, is more of a near-term event and cycle as carriers kind of get sucked down to take care of that. So the Atlanta market essentially is exposed right now. Not a lot of freight coming out of there, but if there were an event of some sort, it's one to watch for sure. That being said, Michael will also have a path of destruction. It's hitting a very low populated area though, with low infrastructure, but still a Cat 4 is going to have significant wind damage, power outages. So there's going to be some impact. I don't know if it's going to be huge or widespread. Sonar would be a great tool to have to kind of check out where the markets are kind of being impacted, and not necessarily in Tallahassee, because Tallahassee is a very low volume market in general, but some of these markets around the area are the ones to watch.
Yeah, and where's the relief going to come from too? I think it's an important thing. And if you use the map, I think that's a very good way to get the overall view of what's happening in the market, and things like the tender volume, of course.
Yeah, like Savannah. I think we found Savannah the other day. I mean, that's a huge jump of outbound volume coming out of Savannah. I mean, this could be related to the hurricane preparation, as it was very immediate. And doesn't necessarily mean that capacity has gone out of the market, because what we're seeing as well is the inbound tender volume in Savannah is doing essentially the same thing. So what this tells me is that this is a very localized move. So we're seeing a very regional move, and that actually makes a lot of sense when you're talking about FEMA stuff, because you're going to have warehouses getting stocked, where military bases are going to be, having some of these trailers sitting in their fields, in their warehouses. So yeah, that would line up.
And I think that's a nice little, again, segue to talk about things like this, for example, which may not show up via the head haul index, because we saw an increase in both. So that's really not going to change the head haul index. But something that we're really excited about, and that is coming out very soon, is some changes to the watch list, which is going to make the watch list an extremely valuable tool in terms of identifying the markets that you're most interested in, or that you move in and out of on a regular basis. And we're going to have alerts and color coding to show increases, decreases in those markets via the watch list. So we're pretty excited about that, and definitely stay tuned to see. We'll probably have that on next week's webinar, be able to actually show what that looks like. And
yeah, it's definitely coming in the next 2 weeks, if not next week. Yeah,
2 weeks to 1 week.
Mm-hmm.
So definitely look for that. Again, we're going to open up now really quick for some Q&A. So if anyone has a question on anything they've seen so far, anything that you'd like to see, again, we're going to try to keep these webinars a little shorter moving forward to be quick, of course, value your time, show you some of the new things and what's happening in the market, and of course answer any questions. So we'll stay on here for a few more minutes and see if we'll get some questions. Again, the Sonar education classes at FreightWaves, November 12th and 13th. We're excited to see many of you down there. And those that are interested in learning more, you can contact us at sales@freightwaves.com, or jump on our website at www.freightwaves.com/sonar. And we'll be on here for a few more minutes, seeing if we have any questions. So we just had our first question, if we have any plans to bring in more DAT data into the Sonar platform for lanes other than the 7 that we currently represent. And being also, just to go further, I think many people on this webinar who are repeat listeners probably have some idea of how the DAT rate is calculated within our system. DAT provides us with the van only rate on these 7 lanes for with the intention of financially settling freight futures contracts when they are live for purchase at the beginning of end of Q1, beginning of Q2 2019. So I guess long-winded answer, as of right now, we'll have the lanes that we have in here from DAT, and we'll stick with those because they're really only for use
Yeah, they're
for
only
the futures
only for
side of
futures.
things.
And right now there's no plans, but we're going to get the futures out in their initial state. I haven't heard any mention of adding futures in any time frame whatsoever.
Well, and I think it's a natural. I think it's also and please add to this or tell me if you disagree, because I know you like to do that. But there's a natural reaction, I think, to or a lot of users want to immediately draw a correlation with tender volume, tender rejections, and DAT rates or spot rates via load board, whatever the tool that you're using. And I think it's important to distinguish the difference between the products and, between what we're showing, and that being that DAT's Rate View does a phenomenal job of capturing rates via the spot market, and what Sonar's goal and the use for Sonar, what its intent is to provide operational information around the contract freight market. Is that fair to say? And that they're, we're certainly, there's certainly affect each other, and that being the contract freight and the spot rates and the spot market. They certainly do, and there's certainly correlations and leading factors, but that we are positioned a little bit differently. And I don't know if you want to add anything to that, Zach.
Yeah, just to kind of add a quick point of clarification. So essentially, our data is there is some connection with operational data and rating data, as DAT is. However, what we are trying to do is not necessarily say our data perfectly correlates, predicts it, or whatever. We're actually giving you, because what pricing data has in it, knowing this from a former pricing manager standpoint, it has a lot of conjecture in there. You have a lot of anecdotal fluctuations. You have these sentiments, and they're all emotional. And our data is essentially trying to rip all that emotion out of it, because the DAT rate and rates in general have some value in the way that a broker will tell a shipper that, hey, capacity's tight, I need to charge you this rate. Mm-hmm. And the broker may think capacity is tight, but it actually isn't. So we're trying to basically say, hey, here's where the market is right now, mm-hmm. Without any kind of like, well, I heard from, Bill or Jill that, that there's no trucks available in Los Angeles today. Well, the data is actually telling me that there is truck available in Los Angeles. So I've kind of pulled up a chart that somewhat illustrates this. You see how the DAT, this is the tender volume index paired with the DAT national rate. And you can see that they do actually follow each other decently over the period of time. But then you'll see situations like this here, where the rate is extremely volatile, and it's because the market is confused. Mm-hmm. They simply don't understand what's happening out there right now. And this is right around Labor Day. And again, the rate going up around Labor Day is not a big shock, and Memorial Day, because nobody's wanting to drive on those days. But still, it kind of recovers real fast and goes up, and it takes a minute for people to kind of figure out what's going on. Because what we're trying to do is provide information on kind of a global level, not a global, but a national level. And a lot of people have data for their one niche. Even the big carriers get tied to specific shippers, and they're going to see things that they kind of focus on entirely. We have data that kind of represents a broad, generalized picture. And that's essentially what we're trying to do here. So I hope I kind of tied that together a little bit better.
Yeah. No, I think you did. I think it's just a thing that a lot of people try to do and users try to do, and correlating the two. And it's a certainly a sticky question, I think.
Yeah.
And what the exact correlation is and what SONAR is actually trying to do.
Yeah, we're not trying to be DAT.
Right, exactly. And I think we may have one more. Let me grab it really quick. No, that's all we have for today in terms of Q&A, and hopefully that last explanation was helpful. If not, please get in contact with the SONAR team via sales@freightwaves.com. Again, all of these webinars are available on the SONAR page, www.freightwaves.com/SONAR. SONAR users, of course, contact your individual account executives or via the help email. We'd love to answer any further questions you may have. And I think with that, we'll go ahead and sign off and see you guys again next week at 2 p.m. Thanks for joining us.